So sorry again. I just had to check my microphone, make sure that it's working. Luco, if you can hear me, just unmute yourself just to for a greeting. Milani, let me know if the audio is back to normal, if it's working well. I've changed, I've set a new audio, so it should be working well. Again, good morning, good evening, good afternoon, depending on the time of the day or the night you're accessing this recording. Perfect. So Luco can hear me, Milani can hear me, so we're good to go. The good thing is I will be able to edit properly the session. So if we are struggling with internet connection or with the sound, the audio, just let me know so that I can set up again my microphone and everything necessary. So let me again reiterate what I was saying, just for the benefit of Luco who just joined us. Most of the time, uh, finance modules or numeracy modules are frowned upon. You know, many students see calculations as synonymous with complications. So, but I have to tell you that should you do the work, what happens most often is that what I've noticed over the years is the fact that students leave work for the last minute. And that I would say that's not a smart idea. If there is a module where you should not leave work for the last minute, this will be that module. So I trust that this is very clear to the class. For now, we are only 3 of us. So like I said, good for you, because if we had a big class, you know, I wouldn't have so much time to dedicate to each student. But it is a good thing that it's only a few students for the semester. Thus, more power to you, more power to you, and you'll be able to benefit. But I just want to make sure that we are on the same page when it comes to doing your readings. And trust me, this is not boring readings, because you do have all the resources, the vast wealth of resources that is already available to you from the start. In other words, what I'm saying, literally somebody could, with all the resources that you have available, you actually could go through all the resources and ace the exam without even needing me. So I'm just here as a bonus, because let's say you are reading learning unit 1, it's difficult for you to understand certain things. Grab the recordings for learning unit 1 for semester 1 or last year. Go through them so that you can understand. It's going to give you a breakdown of the learning units and what are the most important sections that you need to focus on. You have assignment 1. You can check assignment 1. You can check what questions were asked of learning unit 1, and you have all this wealth of material and resources available to you. So uh, I, like I said, you know, from the very beginning, I want everybody to get a distinction. Passing is not enough. I think a distinction, and I would tell you why before we start learning unit 1. Now we're going to be in the numbers just to make sure you understand why I'm saying this, because this is going to be important for you passing the module. So 35% goes to your final exam. So the final exam that you're going to write is about 35% of the final marks. So, but the majority of your marks, 65%, will come from assignment 1, assignment 2, and ICE tasks. So I hope that this is clear, that the more if you make sure that you get a distinction for assignment 1, assignment 2, and you do all your as tasks, you are guaranteeing yourself that you are in a very favorable position to pass the module. Now, but the thing is, if you've not been doing your work, I can assure you that some students struggled. You can fail the exam but still pass the module. Let me repeat that. You can fail the exam, but you still pass the module. But the minimum you can fail the exam, the minimum you can fail the exam is 30%. And you will be shocked that some students will struggle to reach 30%. Like I said, I know from the very start if a student will fail or not. And I will be able to tell you, listen, the way you are going about this module, you're going to fail it. It's lack of engagement, lack of taking, if you're not taking serious this module, you're leaving everything for the last minute. This is not, it's not gonna do well. So like I said, again, I will repeat, if you are a student, you are also working at the same time. Look, I have students who are also working, but they're getting distinctions. So because you have all the resources. And okay, so let's now delve into learning unit 1. Microphone working well? Are you able to hear me properly? Perfect. All right. Thank you so much, Luco. So now remember again, like I said at the beginning, if you've gone through learning unit 1 and there are certain sections of learning unit 1 you are not understanding, here we are. We will have the textbook in front of us. This is not a lecture, this is a tutorial. So we're gonna be more focused on areas that really matter. And this is more of a theory learning unit. From learning unit 2, already you start with calculations, right? You have 8 learning units. And so this is going to be the only one that is really theory based, but it's quite an important learning unit to understand what really, why is this important for you, especially as a future entrepreneur. Why is learning units, why is the finance module important for you? It is important, and it is important because no one can really be successful without looking at the money side of any venture or project that you're gonna do in the future, right? So financial management, as it is, there is 3 main important area. Finance is vast. You need to see that finance is very vast, and that's why this particular finance is tailor-made for you as an entrepreneur. It touches on what is core and fundamental to what you're going to be doing as a career in entrepreneurship. But um, like I said, when you hear accounting, obviously another nightmare for many students. Accounting is really hated by students, but accounting is just a branch of finance. That's just to show you how vast finance is. So accounting is just one branch of finance, and it's a branch of finance that deals with actually the management side of, or the recording side of finance. But the other 2 main areas are the investment side and the financing side. Obviously, whatever business venture you are doing, you're going to need to make some investment. There needs to be capital that is being laid down in order to produce good or services. And that part of investing in assets to earn a return, that part is what the investment side is, because you are investing in an infrastructure, in asset that will be able to produce good or services. And obviously, whatever capital that you get would have a cost. And we will go deeper even into the cost of capital as we go down the module. The cost of capital simply means that whatever money that you're going to acquire, it's going to have a cost, right? It's going to have a cost. So you want to make sure that whatever you are investing in will earn you a return that is greater than that cost. Why? Because that's the way that you're going to make profit. So far, so simple. You just need to make sure that whatever you're doing will give you a greater return than what it costs you. Profit minus expenses minus cost must give you, the revenue, what you get minus the cost gives you your profits. Gives you your profit, right? So, okay, so you have the investment side. I trust that you went through the reading, you understand that. And if you have any question, quickly just on there in our chat. But there is also the financing itself side of things. There is this financing side. And what does it mean? Is that that's where you need actually to get now that money. How are you going to finance those projects? What are you going to do? How are you going to get the money? Okay, one of the things that you can straight over your head you can think about is banks, for example. Why do we look at banks? Because banks, you know, help with the money, right? Capital. They provide capital to somebody who want to do business. But is that money that provided, is that money for free? Sort of to say. Obviously, it's not for free. You need to not only return the money, but you need also to return more than what you borrowed. And that's difference between what you are returning and what you took is the interest that you need to pay. So whenever you have, you have your credit card that you're using for your shopping and all that, there is an interest that you pay. You're using money when you borrow, when you borrowing money, right? So yeah. So let's touch on some of the objectives. Um, Obviously, why do we need finance? This always in your paper: profit maximization and wealth maximization. What does it mean? Okay, you have obviously um, I could feel my microphone tremble there, almost like profit maximization and wealth maximization. It's a the two. One obviously cited and the other is long term. Obviously, when you have a company and you have investors in your company, they want wealth maximization. Wealth maximization talks about over time. It's not just a matter of the short term. All right. So, so for a company, obviously, or the objectives of a business, as a business, and you as an entrepreneur who's going to need to know, who's going to be able also to understand the financial side of things, you need to understand that the objective of any business that you are engaging yourself into should be to maximize the shareholder wealth. Who are the shareholder? As it says, share. So they take a part, they take they take a financial interest in the business. So they own a part of the business. They own a share of the business. So they want wealth maximization, not just profit maximization. All right. So profit maximization, money, how much money was made. Obviously, it will be the cash flow. How much money is one of the tools that you use to check the profit maximization is obviously the APS. What does APS means? Luco, Milani, you can chat. You probably can type faster than I speak. So just let me know what you understand by APS. Wonderful. Liking that earning per share. So meaning that when we are talking about the earning per share, we are talking about revenue, right? Uh, but we are because we're gonna take whatever revenue we get, we need to deduct every cost that was involved in order to get that revenue. And once we do that, we're gonna get the profit. And that's by the number of shares a company has, it gives us the earning per share. All right. But the problem with the earning per share is it's very good to look at the profit. The bigger the earning per share, the bigger the profit, right? That's quite simple. So earning per share is very good, but unfortunately, earning per share does not take into account uh, two things, two very important things that you might have seen in your accounting module. Time value for money, meaning that you would know time value for money. I always give a very simple example. I would say that the amount of money you use to buy bread with in the past is not the same as now. You would see that in the past we used to buy bread at 3 rand or 5 rand, but today you can't buy bread at 5 rand. What happened? So what happened is that money loses of its value over time. So, or money can gain in value over time. In which way, whatever way you look at that. So, but the time value for money is that if we're looking at the future, if we are in the context of a business, there should be interest that is earned on top of that money. That makes that money, appreciate in value. So we need to be able, when we're making decisions, to be able to look at the value of that money in today's money. So 10 rand today would be 3 rand in the past. Absolutely. You are absolutely correct, Luco. Inflation would be also something that you need to take into account. Interest, it's also something you need to take into account. So yes, like I said, remember again that simple example I gave. I gave the example of bread. In the past, you would 3 rand will buy your bread. Today, it might be 15 rand that buys your bread. So over time, so 15 rand to uh, 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 today is 3 rand in the past. That's why we discount back. We need to make calculations, clear calculations that discount back. And we discount back using, in this case, interest. There are calculations where we can look at the inflation. That's not the context here. In the context of the business, remember, we are borrowing money. We are taking money from somewhere, and that money is not for free, and we need to pay interest on that money. So that's why we need to discount back. So whatever projection we're doing for the future, because now this is the most important thing for you as an entrepreneur. The entrepreneur looks toward the future. The entrepreneur looks toward the future, because whatever business you are planning today and it is in your mind, you need to be able to see how much am I going to get in the first year, in the second year, in the third year, in the fourth year, in the fifth year, whatever it is. So you must be able to project in the future. So but APS doesn't do that. APS cannot take into account the time value of money. But one thing that does that would be the share price. The share price is a good way to know the time value of money, because, by the way, if you get question, you'll be able to see, they will probably ask you, I repeat again, this is a tutorial, we go straight to the questions that you will get, right? We don't waste too much time. We are saying they will ask you, what for a business, what is more important, profit maximization or wealth maximization? I don't want to hear you say profit maximization. Of course it's not. The objective of a business is to accumulate wealth for the owners, right? So wealth maximization. And if they ask you to make a difference between profit maximization and wealth maximization, these are the things that you should be able to say, right? You should be able to talk about the fact that um, profit maximization, most often uses APS as a measure, but APS is not reliable, uh, uh, and that's why for wealth maximization, share price, we look more at share price. But APS correlates with price. We're gonna those calculations. APS. Remember, earning per share. Share price is the value of the share, right? How much it costs to buy the share on the market, right? If you want to buy the share of a particular company, you're going to check, the market will tell you company ABC, the share price is 15 rands for the share, right? That's how you buy shares, right? So, okay, please make sure you read through this. Make sure that once you are asked this question, there's no mystery for you, right? And there is some drawbacks to profit maximization. They are here, they are given to you. They are given to you. Profit maximization can be easily manipulated. Accounting profit does not always materialize into cash inflow. So profit maximization ignores the time value of money. That's what we just spoke now. It ignores the risk factor. So APS does not take into account the risks, right? So indeed, please do your reading. So every time you have an example, read through the example because it's very useful. And what I want you to do is, if you see, okay, I'll come to that. See you just sorry, I wanted you to see 1.1. This is very important when you have a question. So from learning unit 2, all the questions that you have, the answer is in the solutions. Okay, so if you're looking at the answer of the question, it is in your learning unit 1. This is theory, and that's why they want you to look. For example, the question of financial manager should identify which area of the business are holding excess or idle assets and should dispose of them. Briefly discuss why this is the case. So make a reflection, write your thoughts concerning this, and we can always discuss those. But some of the questions will be already touching on what you're going to get in your assignment, right? So if you have already practiced and written something, when it's time to write assignment 1, well, you will have already a draft. That's what I mean by this. All right, so let me quickly just touch on I'm not sure about my connection. My connection says that it's poor. I hope that it will get better. But let me just touch quickly on the role of the financial manager. And maybe before that, I've made more notes. I can share these notes again with you if they help you. But it's just to show you places where you need to concentrate. When they say operating leverage, you know, what does it mean in this context? Um, But this particular example is from this company that wants to achieve certain goals. This talks about the objective of the company. Obviously, they have certain objectives. They want to get an average annual sales growth of 4%. These are objectives that they have set up for themselves as a company. But it's objectives that every company would have. Why? Because you want to increase your sales growth. You don't know a company that doesn't want to get more money, doesn't want to increase their sales. That will be a little bit dumb. Obviously, you can increase your sales growth, but you get less profit because also you spend too much money. So that's why you need to make sure that you look after your cash flow growth. You want to make sure that uh, what you get is 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 you get a good profit out of it, meaning that your revenue minus your cost, your revenue is so high. So what you will do is you will increase your revenue and try your best to decrease your cost. Because if your revenue is increasing and your cost also is increasing, it's it's diminishing your profit. I hope that's clear. You don't want your revenue to increase, but also your cost also to increase. Obviously, if your cost grows bigger than your revenue, you don't even get a profit, you get a loss. All right? You get a loss. So just let me know that does that make sense? I can write that for us. You have revenue minus cost equal profit. If your cost is greater than your revenue, it is bigger than your revenue, you get a minus profit. A minus profit means a loss. So this is very important. This is very so you have revenues, and that's why we're saying that sales growth is good because we want more revenue. Sales growth is good. Want more revenue. But we also need to control the cash flow growth. We need to make sure that we are operating efficiently. We're reducing costs. Like in this case, financial efficiency would mean reducing, for example, the tax. Operating leverage would be like shares buyback. We're buying back shares. All right. But the focus is on the return. Okay. Focus is on the return and especially the shareholder return. Now, sometimes we can take what we get, the shareholder return, our profit, we can distribute our profit to our shareholders. That's what we call dividend. When we are giving the profit back to the shareholders. But a company can decide that instead of giving back this profit to the shareholders, we can invest in other projects that will earn more money for the company. That's what we call retained profit. So it's a profit that has been retained for the purpose of investment in other projects. Does that make sense? Is that clear? Is that easy? If you understand these few principles, you are already getting the basics. Perfect, perfect. So like I said, we have option. We have option either to pay the money back to the to the shareholders, but it will be dumb of a financial manager or of an investor or you as a future entrepreneur to give people money while that money could have earned more profit in other projects. That's where financial management becomes very important because you need to do proper planning and you need to do your homework to know whether it's sustainable to give back the money to the shareholders or to invest that money in other projects. All right. So the role of the financial manager is this here. So the primary responsibility will be financial planning and analysis. Remember what I said, planning. It's very important to do these things. And in my annotation, I've made all these things to show you so that, you know, I make it live for you. All right. So one of the two things that are very important, forecasting and budgeting. Very important. That's why you hear financial managers talk about budget. Well, but what is it really? So I'm showing you the difference between the two. It is in your notes, you can read, but here is just to give you a summary. When you're talking about the budget, you are talking about the next year. That's it. If we are making a budget right now, so we are in 2023, when we're talking about a budget, if we are to do a budget, we will talk about the year 2024. That's all. So we're going to do a budget for the next year. So that's the budget. But what is forecast? Forecast is not the budgeting. So there is a difference between forecasting and budgeting. Forecast is when we are in 20, we can do forecasting for this year because we want to make sure that we are on 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 par with uh, um, our actual results. So we want to make sure that we are controlling the movement of money in our company, or we are controlling the financial issues of the company. That's what a finance manager is about, or financial management is all about. So if we are in 2023, the first 3 months from January to March would give us enough information to help us plan for the next 9 months. Remember, there's 12 months in a year. Remember, forecasting, we want to make sure we're looking at the trend. So the first 3 months, we will be doing a forecasting in the first 3 months, the first 6 months, and the first and the 9 months. So there's 3 forecasts we're doing. The first forecast would be we collect that data for the first 3 months, and then we plan properly to see how it's going. So for example, for a company, to make it simple, for a company, they will look at how did the first 3 months go, and then they can project what is going to happen in the next 9 months. I hope you understand. And then after that, they will do another forecast for the first 6 months. They say, oh, we can see, for the first 3 months, it went up and then it went a little bit down. And then they will plan for the rest of the 6 months that will be remaining. It will be like semester planning. So I trust that you understand the difference between forecasting and budgeting, right? There is a nuance there. Financial coordination and control. Obviously, a financial manager needs to be able to control, right? It's a monitoring of activities. The financial performance. We're looking at how the company is performing. We are monitoring the activities. Are we meeting the objectives that we set? Remember, you study your management, right? Very, very important. It's about the objectives, right? You have strategic objectives of the company, and then you have operational objectives. You know all those things. I'm not going to teach you all that, but I'm saying finance is where the money is talking. Are we meeting the objectives? Are the objectives satisfied? And if they are not satisfied, what corrective measures must we take to make sure that we are in line with the projections we made? So there is this comparison between actual and what is happening. We budgeted for 15 million spending. How much did we spend? 12 million. Ah, it is below the 15. So we did well. We budgeted for 12 million, but we have already spent 15 million. So we are overspending. So there is a problem. So what shall we do to rectify that? Am I making this clear? Is it quite interesting? This is the actual thing you guys be doing. You need to understand this. Are we are we in agreement? Milani, Luco, is it comprehensive? Perfect. 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 All right. So now let me browse through the rest. Is also responsible for investment decisions because he needs to make decisions into what asset are we going to buy that will help us meet the objectives of the company. So the financial manager needs to know, and you, if you are doing financial management, you need to know what business or what asset you need to buy that will bring you the returns that you are looking for. Financing decisions. Are we going to borrow money from the bank or are we going to sell shares? There's only two ways. Either we borrow money or we sell shares. In other way, we call people to come and to be part of our business. So we own the business together with them. All right? So very, very important. Okay, so whatever I was saying is covered in these lines. Investment decision, as you can see, what's short-term, medium-term, long-term investment is required. So the financial manager needs to look further. What are the short-term investments, medium-term investment, long-term investment that are required to make sure that we keep a regular return and the business is not going to fail, right? Because the business needs to keep going. Financing decisions will be how the business decides to fund these activities. Are we going to take debt or are we going to sell shares, which is equity? Very important. Yes, Luco, please go ahead. If you can unmute yourself, please. A question.
Sir, can you hear me?
I can. You are soft, but
Okay.
I can.
I wanted to ask if selling equity is the same as crowdfunding.
No, no,
Okay.
it wouldn't be. Um, the thing with crowdfunding, but what I understand is that people are giving. Uh, Again, I'm not saying you are wrong, but I'm thinking with you. When we are saying crowdfunding, are we saying that those people who are giving, are they giving it for free or are they expecting a return?
They're expecting dividends.
They're expecting, then they are shareholders. Because I just want to define that, define the crowdfunding. Because I know, for example, project that the community gave, money for a particular business, but there's no contract between the community and that particular business.
Mm.
So it's like people who, because you can now do even crowdfunding on, different matters. You see, uh, uh, um, there is this app. I've forgotten the name of the app where you can solicit the public's help. You know, but I agree with you. If it is they are expecting, you are opening up to people to invest It means the public. By the way, that's how the GSC works, the Johannesburg Stock Exchange. What basically happens there is that these companies that have gone public solicit the money from the public to invest, but obviously those who are investing in those companies become shareholder. And that's the whole difference. Just make sure that in whatever it is, there is really a contractual obligation that whoever is investing is a shareholder and is entitled therefore to profit dividends. That's a good question. That's really a good question. I like that one. So as you can see, cash management um, could be also something. What cash is needed for? Obviously, two things are very important. We need to make, because if we borrowed money, let's say we borrowed money for our business, we need to pay. Your shareholders will wait for the profit, but your creditors, they're not waiting for the profit. Your creditors need to be paid. So this you need to understand, especially when we're going to look at the income statement. We will touch more on that, on the income statement. There is interest that needs to be paid before you calculate your net profit. That's not going to wait, because your bank is giving you money and every single month you need to pay back. So there's no excuse on that. If you're not making profit, you will tell your shareholders, I'm sorry, we didn't make profit. We're not going to give you anything. Or you can tell them, we made profit, but we don't think we should give you this profit. We want to invest in other projects to make the wealth of the company grow. And again, entrepreneurs, I'm speaking to you because this is real life. When you're looking at Facebook, many years back, it started. It was a small company. Started, the share of the company was worth nothing almost. But today, the people who started investing in Facebook there at the beginning, today they are billionaires because companies grow. And it needs a financial manager who's going to make decisions for the wealth. You see, now you can see the difference. If Facebook at the beginning, do you know that Facebook was even offering its service for free to people? And even today, it's still free. It's only for the people who want to advertise and all that and all that. But why? Is that they were not earning even money at the beginning. But the investors were okay with that. Why? Because the investors were looking at the potential for Facebook to grow and to become what it is today. And now, those same investors are billionaires. So that's the difference between profit maximization and wealth maximization. Somebody who's after the profit just want the cash now. But wait a minute. Wealth, like I said, is in the long run. So we need cash, right? Cash management is important because we need to service our debt. We need to pay back the money. We need to we need to make our interest payment and principal payment every single month. Otherwise, if we're failing to pay, we will be in trouble. You see, we will affect our credit. If you're not paying your debt, you're going to be blacklisted. You know that, right? They're not going to accept you to say, well, I received profit. Okay. Working capital also is very important, because if you are a company and you are buying merchandise, that's why I say working capital, because you are buying merchandise every single month and you are paying merchandise, right? And you are making profits. If you are a retailer, for example, you buy goods and then you sell them and then you get money. So that's what we talk about, the working capital. Working capital. Uh, is one stakeholder, but the community is another. Employees are another. Governments are another. So, but then you will ask me, why? What does the government has to do with this? The government wants to see how your business operates. Why? Right? So understand what each shareholder, stakeholder interest is, because a stakeholder is somebody who has an interest in your company. They want to know. They want to know how is this business, the community. If you are a company that pollutes the environment, the community needs to make sure if the toxic waste you are releasing as a company is going to affect them or not, is going to affect their health. You probably heard about many companies that were doing, releasing things, in the environment that ended up causing cancers. You see, so there are many investments. Not all of them are for the money, but shareholders' interest is the mullah. Okay, so shareholder interest is the ROI. What is ROI? Our what is ROI? Type in there. What is ROI? Milani, that's a good try, but it's not. But that's a good try. Appreciate that. Appreciate it. On investment. Perfect. Perfect. All right. I like that. I like that. So financial market, other stakeholders. Now, when you see a question like this, attempt it. Write a draft for this question, your own answer. So what are the interests of shareholders, creditors, long-term credit providers, employees, government? And do also some research. That's very good. If something you don't know, do research and But again, here I say, dividend decision. We have the profit. Once we get the profit, if we are paying out dividends, profit minus the dividend we paid out, it still gives us return earnings. So let me be clear. It's not the decision that they need to, the financial manager need to make the decision to either pay out all the profit or to retain all the profit. No, sometimes they might decide to pay a percentage as dividend. They can say, okay, 30% of the profit we got, we can pay that as dividends to the shareholders, but we're going to retain 70% of it. Okay, so that's why you see profit minus dividend equal return earnings, right? Very important. That return earning, are we retaining it? Because we can invest it in other projects. All right, so risk management, very, very important. That's where you need to look at your business risks, right? There's three types. Financial risks, the most important, meaning that what is that risk? The possibility of losing money. If you see financial, you see the money, right? And then there's strategic risk. Strategic risk is the risk of not meeting the objectives of the business. And then there is also operational risks. Operational risk is when we are not having all the processes. You see, the processes, if the processes are not in place and we are not properly administering the company, we can also lose money. Let's say, for example, a shop that does not have security. People end up stealing. Well, the company is losing money. And that is an operational risk. All right? So very important. And there is responses to the risk when we talk about financial risk. What are the response tactics? We can either avoid the risk, meaning make things into place to avoid the risk so that the we don't lose money, or we can mitigate when we know that the risk is, for example, at the level of the entire economy. For example, remember COVID affected all the company, but how can we mitigate? How can we lessen this risk? Or another is to accept the risk, especially when a risk is unavoidable. Sometimes we can say, you know what, more risk, more return, right? This is finance, right? The higher the risk you're taking, the higher the return. The lower the risk, the lower the return. So does that make sense? Just let me know. Does that make sense? Perfect. No, we are done. We are done. Don't worry. I'll be time. So that's it. The last point that I'm going to touch before I let you go is the agency relationship problem. It will always come in your paper. Please read this. Obviously, the one who's managing the business would have more knowledge about the business, and sometimes the 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 the, the objectives of the financial manager or the personal objectives of the financial manager, they don't align with the objectives of the business, and they can create a conflict. That's what we call the agency relationship problem. So please read this last point. It's very important. And that's it for your learning unit 1. Obviously, we will catch up soon. Remember to look at your calendar. Um, did you enjoy the session? Just let me know if you enjoyed the session, and I'll let you go. Awesome. Awesome. Perfect. Thank you so much, Luco and Milani, for making the time. Please enjoy the other collaboration, and we will catch up very soon.